Let's do like that. Dean asked question about the company which is tricky to analyze. Okay, so it's because it doesn't have full details on value line report. Let's open it. This company. Sometimes you open value line report and you will see something like that. Okay, you will see that um, it looks very different compared with, for example, Disneyland, right? So it's doesn't have all the information. Usually it happens when the company is small. And this company has about 260 million in capitalization, something like above 200 million capitalization. So it's small. And when the company like that, the reason why it doesn't have so much information, because they are not interested to analyze it. And I'll explain you why. Imagine that all these analysts, they're trying to make money by analyzing big companies and providing these reports to financial institutions, like I mean to banks, to hedge funds, to pension funds, and etc., etc., etc. Now, pension funds, when they invest in company, very often they have this regulation that they can't invest, for example, more than 20%. They wouldn't buy more than 5% in one particular company. Okay, so now if we look at this particular company and the total value of this company about 200 million, so 5% out of it would be about $10 million. Now imagine if this hedge fund has $1 billion in assets, how many companies they will have to buy by 10 million in order to like use all their money. It's about 100 companies. It's impossible to find 100 great companies on the market. Okay, so it's really, really tough and difficult. So that's why they are trying to invest in companies which are big in capitalization. And that's why this particular company is not attracted by all these hedge funds, big hedge funds. They're attracted by probably small ones or private investors, etc. Okay, that's why you don't see this information on projected earnings, because also for small companies it's not easy to project. Why? Because small companies they kind of have bigger challenges than the bigger companies, because big competitors can come and cut their prices and practically destroy small company if they don't have enough kind of support, or maybe client base which is going to buy only from you, etc., etc. All right, and anyway, let's have a look. First of all, you don't see timeliness here. Usually, instead of timeliness, they put performance or technicals. Okay, so you can use this one as instead of timeliness. Okay, because that's what to show. Safety here, beta here, financial strength. We see it. Now we also see like compare with Disney, its earnings predictability is 60 only. Yeah, whereas Disney has 100, and then pretty similar, straightforward. So sales, earnings, we have it. So we can see that the company sales level was growing steadily, which is good. Now, when we look at earnings, we can see there was a drop here. Like it was growing from 2008, right? And from 2013, it had a drop, and it's growing again. Okay, we don't know what to expect here in the future. Now the next thing we see that started paying dividends, so it's a good thing. Book value is growing again. It's always good to go to financial of this particular company, and you can go to the company website and try to get there. But I actually went to this particular company and I couldn't find any financial reports on their website, which is strange, okay, because usually they're obliged to provide it. The next thing, average price earning ratio, we can see that it moves from lowest 11 the highest 21, and it was in 2014. So I presume the price moved faster than their earnings because people expected the growth. Okay, that's probably was something good happening in that particular case. Dividends, and then again by company, we can see that in now where's net profit margin, it's pretty healthy, very good one. So it's around 20, so which is good compared with Netflix, which has only 1.4. So it's a good point here. And okay, so that's about it. Now the growth rate for the last 5 years, we can see that 23% and earnings 28%. So in average, so which is fantastic, right? But we can see that they expect to slow down their growth. From current assets and liabilities, if current assets 79, total assets 140, current liabilities 19. So current assets much higher than current liabilities, which is good. Okay, which is good. Now debt zero, fantastic. Okay, especially for small companies, it's important to have no debt if they have some troubles. Now capitalization, they don't have this capitalization. So what you do, you take 7 million shares and multiply it by current share price is 40. So 12 7 by 40, it would be what, about 24, 2.4 240 million dollars is capitalization of this company. Here, smaller news, like much less information about this particular company. And okay, so we don't have any projections. So what do we see here? First of all, industry rank, we can get it from value line. Timeliness, instead of timeliness, we'll put technical here or performance, whatever you like it, because similar. Technical, they use technical analysis, performance based on performance, and value line has 1. Safety, it has 4, debt 0, we'll get that. Beta still there. We have growth for the last 5 years, but we don't have growth for the future years. Now here you can put next year if you want to. Okay, another alternative where you can go and browse and try to find it using Finviz. So that's technicals. We also can see it here. Okay, what we can see, price earning ratio is 17, so it's not lower end, especially for small companies. And price earning ratio future is 16. So this company expect that it's going to grow, right? So that's good kind of. Capitalization 297. So based on the new price with $40, and then book per share is $15. They pay in dividends, and okay, so a lot of figures are missing here, and it's important to know. All right, so that's where we can get information. So earnings per share next 5 years will grow by 15%. That's what they expect. Okay, I don't know how they derive to this number, but that's what they expected. And they show that earnings per share last 5 years was 14%, whereas value line gives us different number. It was 29. So definitely discrepancies here, but at least it can give us some kind of guidance regarding that. So you can, Dean, look at this particular. Another website you can use, it's NASDAQ. If you go and look at projections there, but I already looked there, you won't find it. So there is no information because it's such a small company. Analysts on NASDAQ, they are not interested in that as well. Okay. So, and the target price is $43. Target price $43, whereas at the moment the price is current price is nearly $40. So it has based on estimates, it's quite high already. This company is located, I understand, Israel. It's not US company. Probably that's another reason why they don't have this much information on that particular thing. Remember that there is a conflict in Israel all the time, so you never know how public reacts on any company. I remember the reaction on SodaStream. They also had this plant in zone of conflict, and the price was really affected by people stopped buying. They were boycotting Israeli products just because I'm in that conflict. So you have to take into consideration. Now, if you go to Nasdaq, you won't find for this particular company, but quite often you can find certain predictions there. They wouldn't tell you in percentage. You have to figure it out yourself. What the projections of growth you can expect. Okay, you see, a lot of information won't be here updated. So usually, if I want to compare my opinion with other analysts, I will always go here, and there is analyst research. Click here. And anyway, when you open here, you will see certain tabs, and you can look at what their projections. And in some companies, they have up to 3 years future projections, how much the company is going to earn during these 3 years. And you can use this information for putting in a table if you want to. Okay, but at this particular moment, Silicom doesn't have it here, so you have to use your own judgment, and that's why I left in this table. If we look Silk again, I left 8 and 12, same as in value line, okay, for 1 year. So I didn't put any projection for this. Profit increasing, management solid, they have used challenges, so it's pretty good company from quality perspective. Okay, now if we go for price, we analyze the price. Now dividends, you have this information. Now this is information is not available for you as well. The way I got this 10%, it's very simple. What I did, when I calculated this, I put all these highs, I put earnings, and eventually I come up to these ranges. Okay, that between 22 and 34 it's buy, between 34 and 45 hold, and above 45 to 56 sells. So based on that, I put okay, their potential growth up to $56. So it means that from $40 to 56, we can expect about $16 in growth. It's about 30%, okay, growth. And then I took 30% and divided by 3 years. So it's about 10% a year. So it's just roughly, okay, I didn't use compounding here, nothing. I just use it like that. That's why I put 10. Okay, because it doesn't have that much potential to grow until the highest point. But when you look at this, it comes already in a higher level of hold position. So if we're trying to keep this company and buy this company, I would look at the levels below 34. And in technicals, if we go back to here, that's where it was. It was in June this year. So that's when the drop. So if you expect that it's going to drop back to 26 bucks, so that's probably where you can enter the situation. We already missed this opportunity of Silk. Okay. And okay, let's have a look. Any other items? You have this, so it's easily to put. So yeah, probably that's the only parts which you were missing, Dean, right? Uh, can you put a cross and write if I am something missing? Yeah, only 83 employees. It's very small companies. But can you imagine for 83 employees to generate like 240 million in sales? It's quite good, right? So it's not bad. Now, generally, when you invest in small companies like that, you need to understand it much, much, much better. Like, I mean, guys, you are professionals in your areas, and you can make quite a lot of money if you try to identify small cap companies, especially if they're below $100 million. But you will be able, because if you're expert in these areas, you will be able to analyze them better than anyone else. If you know their product, if you know their management, if they know how to they aggressively acquire market, sometimes you will find another Microsoft or another Apple or another company which okay, maybe they're not going to go that big, but at least they will grow to a certain level where they will be noticeable by bigger hedge fund managers or bigger companies, and they will be acquired. And usually some companies they have this target, small companies, when they start growing, then somebody buys them. Apple, Microsoft, Cisco, they just buying them instead of building up competition. They just taking them from the market, and that's it. And you can make quite a lot of money. Sometimes you can make up to 10 times uh, from your investments. So there are some companies growing like that. Okay, guys, any other questions for tonight? If you have, please ask. So what we're going to do, we're going to have similar type of every month now. And if you would like to have any particular topic, we can go and do that. Okay, so because for me it doesn't really matter which we're going to discuss. So if you have any ideas, please send me probably 2 weeks or like anytime you have this idea, send me this information and I will try to prepare it for you. All right. So because the idea is to give you as much knowledge as you can receive. Okay. If you don't have any questions, I wish you a really profitable week, month, and they have a fun as well. So invest in companies which interesting to read about. Okay, guys, all the best. See you next time.